So I am Matt Hogan, Senior Vice President of Project Development for CMB Regional Centers, but I'm also a Senior Vice President of our sister company, NHK Capital Partners. And so right now I'm going to talk to you a little bit about NHK rather than EB5. So what NHK is it is a traditional private equity company that provides more traditional market rate real estate investments in the US. So who we are, that's who we are. We established NHK back in 2019 with the thought that, we have worked with over 6,500 investors from over 103 different countries, I think is what we're at right now. And we've had many of those investors go full circle through the EB5 program, get their conditional green cards, get their permanent green cards, get return of capital. And many of those investors come back to us and say, hey, we've built this great relationship. You work with some of the best developers out there. But I didn't earn a big rate of return on EB5 because that's not the point of that investment. So do you have anything where I can earn a market rate of return? Absolutely. So we decided to put together NHK Capital Partners. It was formed by the president of our company, Noreen Hogan, and then her brother. They happen to be my first cousins, or my dad and their dad are brothers, and it's created a great opportunity to have an expanding family company. But NHK has been fantastic in that it can provide smaller, more risk mitigated, more manageable market rate investment opportunities to allow people who have recently immigrated to the United States, or anybody really who's interested in accessing the US real estate investment market. We've done a number of different projects already. In total, we've got about $140 million in assets under management. One of our marquee properties, JW Marriott in Dallas, Texas. It's operating, it's a beautiful hotel. We've got investments in office, investments in logistics, but one of our primary focuses has been single-family rentals or build-to-rent communities, in particular in Texas. Texas has continued to be one of the fastest growing states in the US over the last several years. You can see currently we've got $57 million in assets under management in those types of properties alone. That asset class is continuing to grow, as I mentioned, in particular in Texas, because you have companies relocating there, people wanting to be there. You have economic boom happening there, in part driven by the fact that there are no state income taxes, very friendly business environment. You've got some of the biggest companies. Tesla's moved down there. You've got Samsung building a multi-billion-dollar chip manufacturing facility down there. Some of the largest insurance companies in the US. You've got people consistently on a day in, day out basis moving from New York, California, Illinois, some of these areas that have traditionally been gateway cities and states that have thrived, that have had little tougher economic challenges. Texas has been able to take advantage of that growth. So what this is going to do is it's going to play directly into that. One of the challenges, obviously, when you have explosive growth like that is being able to keep up with demand for housing. Well, you can continue to build, but then when you have a higher interest rate environment, then you also have challenges with people being able to afford mortgages that allow them to buy those homes. So you have people, young people in particular, continuing to consistently move to this area for job opportunities and things like that, and in a more affordable cost of living. Because they're not particularly interested in purchasing homes right now, because of the higher interest rates, they're waiting to see if those can come down a little bit. Build-to-rent communities have really thrived, and multifamily in particular has really thrived. What you're doing is you're fitting a niche, you're filling a niche, rather, in that you can provide an opportunity for younger families, people who have just recently moved to the area, the opportunity to rent something that feels a little bit more like a single-family home, but again, they're not purchasing it long-term. They can stay there for a couple of years, and they can go start to look at buying that single-family home over a period of time. And so what we're doing with Wolf Creek is one more build-to-rent community. This one's located in Melissa, Texas, part of the Dallas-Fort Worth Metroplex area, the fastest growing metro area, or one of the fastest growing metro areas in the United States. Austin and Dallas have gone back and forth over the last several years in terms of who's going to outpace each other as far as growth is concerned. So we're going to do 343 units. And the beauty of developing in Texas right now is you can still get land at an affordable cost basis. So rather in a more densely populated downtown urban environment where you're going to build vertical, you can build horizontal. So essentially you can build properties. I'm going to skip around a little bit here. Whoops. That look a little bit more like a single family home community. So people can have a little bit more space. They can have a little bit more room. You can still amenitize it similarly to a multifamily building, but now because you're going horizontal, the feel is much more like a residential community. But again, building it for rent. We're going to take advantage of this growing market. You can see where we're going here is north of Dallas. CMB's offices, NHK's offices are actually just a little bit further down this road, just south of where it says Richardson right there, so a little bit closer to Dallas. This is our hometown, basically. We've done a lot of development in this market. We understand this market, and that is the direction of growth. We're continuing to see the building boom in those areas in particular, Melissa being one of them, but obviously McKinney, Allen, Plano, Frisco, Sherman. These are all areas that are close proximity to that. Great school districts, great job growth, again, great development opportunities at an affordable cost basis, which is key. So from a unit mix standpoint, we're going to go 1, 2, and 3 bedroom units. As I mentioned, a total of 343 units. The target buyer here is not the ultra luxury buyer. This is not the Dubai real estate market. We're filling a niche for, as I mentioned, younger families, young professionals, people who want to relocate there, but aren't quite ready to buy a home yet. And so the demand in that particular segment has continued to be incredibly strong. Rent growth has continued to remain steady. And as far as predictability in terms of deliveries that are going to be happening in that market, in terms of continued opportunities that are going to continue to manifest in that market, we think that this is going to fit in with this area. It's going to fit that community. It's going to be delivered at a time in which we can continue to take advantage of that growth. So, to tell you a little bit more about, and as I mentioned, I'm going to skip around here so I don't keep you guys here all day. I appreciate you sticking with me. Again, DFW metro area, over 8 million residents, 4th largest MSA in the United States, behind New York, Los Angeles, and Chicago. You can see median income, 10% higher than the US average. It's gained 32 corporate headquarters. That's what I had mentioned before. We're seeing massive relocations from states like California, Illinois, and New York in particular, areas that want to take advantage of not only the pro-business environment, but they know the employment base is going to be there. People want to be there so they can get the best and the brightest. Those people want to be there because there's no state income tax. Okay. So, the sector, as I mentioned, this area, continued growth in this particular asset class. You can see it consistently and steadily outpacing single-family housing developments. You can see mortgage payments have continued to increase because of the increased cost of borrowing. That trend is going to continue to remain relatively steady. This last month, we didn't see another interest rate decrease in the United States. That's going to hold steady. It's likely we'll see some decreases in the future, but that's going to take time for the borrowing demand to come back, and the drivers that will push people back into wanting to buy single-family homes. And again, it's going to fill that niche of the nationwide housing shortage. Okay, from a financial standpoint, as I mentioned, let's skip around here just a little bit. From a total cost standpoint, project's going to cost about $104 million to be completed. It's going to secure, it already has secured, a first lien construction loan. This investment's going to be a common equity investment. So it will be in the form of equity. We'll have a target rate of return on this one, an equity multiple of 2.46, target IRR of 25.33%. So in total, NHK is going to be raising $21.3 million. What we do in these NHK projects is typically we are funding this equity, we're bridging this equity from the family's funds and then availing this to investors who want to buy into a portion of that equity and take a position within this structure. Why do we do that? Well, we do that so the project can continue to move forward. The project is already under construction. It's progressing very well, so it's risk mitigated from that standpoint. It's already secured its construction debt, so it is going to get built. It is going to subscribe very quickly. There is still limited availability left in this partnership, and so if there's any interest in this, if you guys want to learn more about it, feel free to approach us. We'll be at our booth outside. We'll have folks here tomorrow as well to answer any questions that you might have. So again, thank you so much for sticking with me. Thank you so much to the IREX team for the event they've put on. It's been a great event thus far. Hope you guys enjoy the rest of your day.